Hello, everybody. My name is Robin Johnson, Head of Investments at Nedgroup Investments, and I have the pleasure of recording this webinar session with Stephen Romick from First Pacific Advisors, FPA. He is the co-portfolio manager on the Nedgroup Investments Global Flexible Fund, and he has been managing the original strategy for the FPA Crescent Fund since 1996. The original strategy is independently rated as gold by Morningstar qualitative analysts, and also the Nedgroup Investments Global Flexible Fund has a silver rating relative to its European counterparts or peer group. I'm very pleased to say that the performance over the last 12 months for the Nedgroup Investments Fund has been phenomenal, outperforming its European peer group by 16% to the end of June, which has placed the fund in the second percentile over that period. Now, we don't like to look at short-term periods, so over 3, 5, 10, 7 and 10 years, the fund is also ranked within the top decile of that Morningstar European peer group. Now, there's been some interesting changes over the last quarter, so I'm going to hand over to Steve now to take us through a short presentation of the contributors to performance, what's the composition of the portfolio, and what their thinking is going into the future. At this point, I'll hand over to Steve. Thanks very much for joining us, Steve.
Thank you very much, Rob, and thank you, Nedgroup, and everybody who's joining this recorded call. We at First Pacific Advisors and the Contrarian team really appreciate you allowing us to steward your portfolio, and I'm going to like to take this time today to walk through what this portfolio looks like and give you a little bit of a view of the world as a whole. So let's dive into this. The best place to begin is probably looking at the objective, as always, which is to achieve equity rates of return over the long term with less risk. And by less risk, we really mean to avoid permanent impairments of capital. We do that broadly by investing with tremendous flexibility around the globe in different asset classes. And just because we have lots of different things that we can do inside the portfolio, distressed debt and high yield as part of it, doesn't mean that we always should. I'll explain a little bit of that later as well. Our emphasis has always been on capital preservation. We don't like to lose money, which does not mean to say that we're not accepting of negative marks in the portfolio. At a point in time, the world goes haywire. You can see the portfolio go up or down, a fair amount. But most importantly is what kind of permanent capital is absorbed, over time. And fortunately, over time, we've been very good at owning good businesses at good prices, and the portfolio, as you will see, has performed quite well. Diving into the review of the portfolio, let's begin with the asset class, composition. The equities today are currently 74% at the end of June. Excuse me. Not far off from where they were in the first quarter. The biggest portion of that difference is largely our SPAC position, which I'll explain later, which is up a bit from a year ago, but that's largely through appreciation. And in fact, if we had held everything, from a year ago, the risk exposure in equities would actually be even higher than it is today. Some money's been taken off the table. But you also will note that bonds are pretty close to a low, and those bonds are largely, as always, high yield bonds and distressed debt that exist within our portfolio, because that meets our goal of equity rates of return with less risk than the market. And traditional conservative fixed income is not historically something that we've really engaged in. We prefer to assume some level of credit risk when the opportunity presents itself and avoid the interest rate risk, factor. The number of equity positions currently are in the mid-50s, so relatively consistent with the prior quarter. The number has increased slightly from a year ago, and that's largely a function of having taken some profits and some names that have worked out and building some new positions as well. Asset allocation reflects large active share, as always. The Global Flex Fund doesn't consistently look like any index or other fund in either its sector or regional allocation. We go where we find value in debt or equity globally, and one will usually find us quite overrepresented or underrepresented in any one sector or region. Our portfolio is very diverse internationally, globally, and it can be reflected two ways, both as in country of domicile as well as in revenue share, where revenue source, I should say. So although we have 62% of our equities located inside the United States, that is overstated a bit because of the SPAC exposure in the portfolio. That's a little less than 3%. But more importantly, the revenue exposure, where those revenues are sourced, largely comes from areas outside the United States, with just 40% and change coming from inside the United States. Global Flex, looking at the return slide, has achieved its objective over time, as you can see in this table, and as Rob mentioned in his introduction. Performance contribution in the last year, and I'm really going to focus on the last year rather than the quarter to date. The stocks in general have, as everyone well knows, can at times exhibit tremendous volatility, both the market as a whole and individual securities. A lot of fear and hope, will end up as competing interests at various points in time. More of that volatility shows up on a quarterly basis than it does on an annual basis. Therefore, I'm really going to focus on trailing 12-month performance, where there's much less noise. As you can see, the top performing positions added 11% to return in the trailing 12 months, while the bottom 5 detractors, or the top 5 detractors, I should say, actually took away 1%. Performance contributors and detractors reflect our diverse portfolio. You can see on the contributor side that there's 2 tech stocks, 2 financial stocks, and a global metal and mining stock. Today, you'll see the gap between growth and value remains very, very wide. However, I think when the gap was previously this wide, as you look at this chart that reflects growth index and the value index at the S&P for the S&P 500 on a price to sales basis, the last time it was this wide was back in the late 1990s, early 00s. And on average, at that point in time, companies were in the value cohort were better than companies that are in the value cohort today. Today, there are more disintermediated and growth challenged companies, making the gap, although wide, not as reflective of opportunity in our view. So despite appearing very inexpensive, we would argue that it's not as inexpensive as it appears. And the next slide will show you a little bit more clarity how we see the growth and value disparity. This looks at the valuation spreads by comparing the cheapest quintile of the market to the market average. And you can see these big bumps going back, over the last almost 100 years. And when the spread really widens out, that's when we tend to get more invested. That's when we tend to lean into the market and increase risk exposure. And most of those bumps, really, the bigger bumps, all occur during recessions, although not every recession. And there is a colored bar missing on the right, because clearly this global pandemic created and fostered a recession, and that created an opportunity to lean into the market a year ago, which we certainly did. That gap has narrowed, and it still reflects that there is somewhat relative opportunity in the market, and we continue to maintain exposures because of that, although the world is not as cheap as it was a year ago. If you look at high yield is anything but, as the chart title describes. And again, in this chart, we're also unfortunately missing a recession bar chart, but what's a bar, I mean. And what's surprising is that every time you get recessions, high yield, yields might be relatively weak, but spreads pop open. And the spreads didn't really get to be that expensive. This chart shows yields that are an all-time low and clearly not reflective of risk. We view this largely as return-free risk. But what this chart doesn't show, which we could just show as an overlay, and it would be good to show in the future, is what's happened to spreads. And spreads tend to pop open, at recessions. And that's why the yield doesn't always tell the whole story. But it doesn't make sense for us to be buying for our clients and ourselves alongside high yield. Just because we have lots of places that we can go and invest in portfolio doesn't mean we should go there and invest in them. And to get a yield on a gross basis that offers something less than 5% before defaults, so it's going to net something lower than that, is not something that's of any interest to us, and therefore explains why, in picture form, why our high yield exposure is as low as it is. As I mentioned earlier in the presentation, SPACs are a sector of the market that we found relatively attractive. We created a basket in the portfolio. As you can see from this chart, that SPACs that are blank check companies that raise a lot of money from investors in the hopes that their equity sponsors will go and find an attractive acquisition. We're trading earlier this year at a premium of upwards of 25%. So these are companies that are just blank check vehicles, as I said, that offer hope of a good acquisition that might come down the pike. That doesn't make a lot of sense for us to buy something at a 25% premium in the hopes that something ends up being attractive. However, that premium is narrowed down to zero. We've actually been able to create a basket of SPACs in our portfolio that trade below their trust value, below the value that we can get back at the point in time where either the SPAC expires, they have a limited amount of time for them to acquire a company, and we can get those dollars back. So generally speaking, that means $10. We buy these at a discount to $10, and we can get back at the very least $10, and we have a free option of an attractive acquisition coming our way where the SPAC trades to a premium. And so for us to be able to get this kind of free option and get a return that is better than cash, but the potential to have something more, is an attractive place for us to invest. And that's why we have a few percent of the fund in this sector. To close, a few broad themes, and some of which I've addressed during the course of our presentation. One is that price matters. We are price sensitive. We are not going to buy a company regardless of price. We want to buy a good business at a good price. And that speaks to the second bullet, which is business quality. We want a very good business. And we're just because, as I pointed out on the slide earlier, value indices are traded at a discount to growth indices, or specifically the S&P 500 value index trades at a discount to the S&P growth index. That doesn't mean one should just go and buy value stocks. One has to be very particular about what they buy, the business quality, and make sure they're paying the right price for it. And for that, for us to continue to invest the portfolio appropriately, we have found more opportunity outside of the United States. And our portfolio, as pointed out earlier, currently has about 38% based outside the United States, which is really higher if you take out the SPAC position, which I think is germane. We are very mindful that interest rates are at all-time lows, and that could change, and depends on how it changes and what causes it change. Could wreak some havoc in the market. So we are sensitive to the lack of opportunity the high yield offers because of low yields. We're sensitive to the fact that many companies, public equities, are benefiting from low interest rates and how that might change. And we have a lot of cash sitting in reserve for us to take advantage of opportunities when they might present themselves in the future. I thank you, and my team thanks you for your time today. And I'm going to turn it back to Rob Johnson for some Q&A.
Thank you very much, Steve. That was incredibly insightful and comprehensive review of the portfolio. First question I'd like to ask is about the SPAC position, or special purpose acquisition companies. We're not very familiar with those businesses. They're very new to the investing world, and it feels like they've just come up in the frothiness of the market that we've seen in the recent past, and people looking to allocate more capital to growth areas. Would you mind just describing what the composition of these portfolio is? Just remember that we only have about 2.6% of the portfolio spread across 50 holdings, and therefore that would be, if any single one of these businesses were to have a negative impact, it would have a very small effect on the portfolio. Would you just take us through the rationale behind adding some of these positions into the portfolio?
Well, there's over $200 billion of capital has been raised for SPACs in the last 18 months or so. It's a tremendous number. And that actually represents, and because this is money that can be used to acquire other companies, and then more money will be raised alongside in both equity, it actually represents buying power that are multiples of 200 billion. So is it a trend, for the future? I couldn't tell you. It's SPACs are here. I believe they're here to stay. I don't believe that the world will raise as much money on average as it has. But because so much has come so quickly and so many have mediocre sponsors, everybody wants to get in the game because it's easy money, for the sponsors. It gives them a lot of, quote unquote, free equity, for them, but not necessarily great for others. And a lot of them have traded down dramatically after they made their acquisitions that have been, quite poor. But you see everybody getting in on the game. You've got rappers, you've got, professional sports stars getting a tremendous number of legitimate firms as well. So, to separate, the good from the bad, in advance is not entirely easy, but we are really a bit more agnostic as to what we're doing. Like, look, we'll buy any of them. Like, who knows what kind of acquisition they'll end up getting? As long as we are buying it, at a discount and we can't lose money, stranger things can happen, and some Major League Baseball start coming up with a good acquisition.
And then another thing you touched on in your final slide is there's more opportunity outside the US. And I noted that your exposure to domicile for North America was about 62%. And actually, having looked at the MSCI World classification recently, North America, so US and Canada, actually account for just under 70% because of the recent rise in that market. So you're actually already a little bit underweight if we're comparing to the MSCI World. And so, would you mind touching on just a couple of those interesting ideas that you're finding in Europe and Asia?
Well, we are more underweight in general than even the 62% in the U.S. shows, because that includes the SPACs, and those are not even companies yet, really. But a lot of the businesses we're finding outside the United, I should have had a slide in our deck today that really reflected in general the fact that PEs are lower outside the United States. But I don't want to go and speak so strongly and say that so many of these companies are dirt cheap. They're not. This is more of a relative statement than an absolute statement. We own a number of different Asian internet companies that continue to trade less expensively than U.S. peers, partly less expensive today because of China crackdowns. We think that's interesting. As an area, we've got Glencore in the portfolio that was mentioned earlier as one of the as that global metals and mining company that is obviously based outside the United States, and time that's performed well. We own two cement companies outside the United States, Heidelberg Cement and Lafarge Holcim Cement. Global businesses, although they're based outside the U.S., they're not. They have sizable businesses inside the U.S. as well. And those are just a few examples, in the portfolio.
And final question from me is that part of the portfolio that has been a huge contributor over the last 12 months has been US financials. We've seen a rebound in a number of those stocks that has caused you to remove some of them from the portfolio. Which of those would have been?
Our portfolio across the board in financials has been reduced, and some have been eliminated, but some have been reduced as well, and some are still in the process of being reduced. And so, having I think it's important to focus on the broader, context here, which is they're not as attractive as they were. Some of these businesses, and again, I don't want to mention them all by name because we're still engaged in some of them. I don't want to go in and give too much of a window as to what might come next to create any kind of competition for us. But clearly, these companies weren't as attractive as they were. Clearly, they don't offer the same growth opportunities that some of these that we own in the portfolio, do. And so you should expect, that as we continue to be mindful of owning higher business quality companies, with at good prices, again, price matters, that these positions, as they rise, will continue to reduce, in size in the portfolio.
So in summary, from Steve's presentation today, you can see that there is some valuation that you can find in the equity markets around the world. There's been a relative valuation divergence between the US and the rest of the world. So we're finding more opportunities there. And we're not finding a lot of opportunities in the high yield and distressed debt markets that have been a feature of the portfolio in the past. As you can see, even in the credit markets, that yields are low and spreads are at all-time lows as well. So return-free risk, as Steve described. You can also say that he's wary of where interest rates are and what a rising interest rate environment might do on some of the companies within the broader market. Therefore, they're still focused on quality businesses. So thank you very much for joining us today. And thank you very much, Steve, for taking us through your positions in the portfolio.
And thank you, Rob, Nedgroup, and our shareholders, investors for participating in this call. We appreciate it.